Well, the oil crisis. The oil crisis now and massive oil price cuts are probably exactly what are leading oil or in 5-year break-even inflation rates to start skyrocketing again. The 5-year break-even rate, remember what this is. This is a difference between inflation-protected securities and yields on the 5 years. Okay, that might not sound like English either, but basically, the higher this chart goes, the more angry Jerome Powell generally gets. So this is why over here in February, after that hot January data we got, these 5-year break-evens really ran away, and the Federal Reserve had to get quite aggressive, really Fed speaking us into this idea that, hey, we're gonna go a lot higher for longer. You know, we said 5.1%. Remember what J. Powell said on February 1st and 2nd? He says, hey, we said 5.1% as a terminal rate in December. Yeah, if I had to redo those numbers now, I'd revise them a lot higher. Partly because the break-even rate of inflation was starting to skyrocket. And now, even though we just had good numbers on the break-even, or on PCE, which is the Fed's preferred inflation gauge, why would this particular chart be skyrocketing? Why? Why would this be going up? Well, it's of course now because we've got OPEC Plus cutting oil by over 1 million barrels of oil a day. Now, yes, we have countries like Brazil, Canada, and Norway, and the United States trying to increase production, but I just want you to understand the difference here. Brazil, Canada, Norway, and the United States are trying to increase production to the tune of 100,000 barrels per day. OPEC Plus is now trying to cut production by 1 million barrels per day. Why is that? Well, basically because they want more money per barrel of oil. That is the whole point of OPEC, to try to maximize profits for oil-producing nations. Instead of driving prices straight down, the idea is let's get as much capacity as possible and basically print barrels when prices are high. If prices fall too low, then let's just cut production together and prices will go back up and we'll all make more money per barrel of oil. Unfortunately, that's quite inflationary. Now, one of the reasons these cuts didn't come sooner is because oil hadn't been falling that heavily. I mean, beyond the bubble of sort of that crazy peak in the 120 barrel range that we saw when Putin invaded Ukraine. Oil's kind of been bobbing around relatively decent levels. However, in this last quarter, oil plummeted, and it had its worst quarter since April of 2020. That's pretty extreme. In fact, oil fell as much as 7% just last week, which is pretty wild. Part of that had to do because of, actually, let me rephrase that. Rephrasing, oil had its worst quarter since April of 2020, but last week we did have some drama that actually, it didn't fall last week. We actually had a little bit of a rally last week because of the drama between Iraq and Turkey. Those exports are expected to resume. That is, some oil exports were paused in the region there, leading oil to actually already run up 9%. Now it's moving up another 6% on top of that. Maybe if that oil production continues, maybe we'll see that kind of 9% rally go away and sort of extinguish that 6% that we're seeing today. But the point is, a lot of news coverage is focused on what OPEC Plus is doing, and not necessarily just what's going on between Iraq and Turkey. Why does that matter? Well, much of oil pricing has to do with speculation in the futures market. Why is that important? Well, it's important because if people again start trying to believe that oil is going to go to $100 a barrel, we'll start seeing that pricing into the market. Now, we might not actually make it to $100 per barrel, but you do tend to start seeing that trend towards it. Right now, Brent's at 84.43, and WTI is basically at $80. Seeing Brent move up another $10 to $95 on these oil OPEC price cuts, possible. And the problem with that is, as oil rises, inflation expectations, unfortunately, go up. That's why we're seeing this spike in the break-evens. Because the financial crisis woes started fading away. The fact that, the banking crisis for sure was going to destroy our economy. That seemed to have been a little bit more of a passing moment here, this financial crisis. And hopefully the riskiest banks have now gone through their pain, and hopefully there aren't any other Silicon Valley banks out there. Hopefully. But then again, remember, hope is not an investing strategy, so you could always expect for more of a banking crisis coming. But this surge over here in break-evens today really this surge on the right over here is clearly because of the oil price cuts over at OPEC. The oil production cuts, and it is inflationary. It's absolutely an inflationary impetus. In fact, let me show you a chart, and this chart is pretty neat because this chart basically lines up inflation and oil prices, and it's pretty obvious. So if I grab this chart here from JP Morgan, pop it on screen right here, what do we see? US CPI, which is obviously our inflation gauge, and Brent. That is the international blend of oil, not to be confused with WTI. When you hear WTI, just think Western, Western. And then also think win. And when you think win, think how you could win 12 free stocks with Webull by going to metkevin.com/free. Sponsored. But anyway, okay, so CPI and Brent, what do we have here? Percent year-over-year gains. Okay, so this is a chart of year-over-year gains, and it looks like Brent is the first line over here, the black line that is, and you see this pretty clear correlation. In some cases, it actually looks like the black line goes up first, and then inflation goes up. Now, keep in mind, this is not core, so it makes sense. Energy is obviously a big part of headline inflation. So it does make sense that you see the black line move up, and when it moves down, CPI could potentially come down. Though they're not perfectly, it's not perfectly clear that one leads the other. I think many of us will make the argument, though, that obviously if oil prices go up, inflation is going to go up. And look at this. Oil prices have come down, and inflation has come down. That's great. But what happens now if, because of these essentially production cuts, inflation ticks back up again? Well, then we're stuck with the higher for longer regime of the Federal Reserve, and maybe we have to start undoing some of the price cuts of the interest rate hikes that we're expecting for the Federal Reserve. Markets have started, after the banking crisis, pricing in that the Fed's going to cut rates as soon as June because of the banking crisis. And after they cut rates in June, then by December, they'll have ended up cutting a cumulative 100 basis points, which is essentially 1%. So a start of a 25 BP cut potentially in June, and then thereafter more cuts. That's been heavily priced in because of the banking crisis. But if the banking crisis is a nothing burger, and we go back to worrying about inflation, and inflation then gets accelerated by oil price cuts, then we end or oil production. I keep saying that wrong. Oil production cuts. Then we end up having larger problems. And we're not in the kind of market right now where we really want larger problems. Now, so far, even though oil prices are generally speculative in terms of futures pricing, so far, markets aren't reacting too terribly. I mean, some tech stocks are down a little bit more than you'd expect. Tesla's down, NASDAQ's down about 0.6%, even after Tesla smashed its delivery expectations, which we'll talk about separately. But really, I think the fear now is, okay, banking crisis gone means maybe less chance of Fed cut, maybe time to sell. But then again, positioning in the stock market is already terribly low. I mean, consider the data we talked about yesterday. Bank of America told us that positioning in the stock market is at an 18-month low. Bank of America also told us that cash positions are at a 3-year high for individuals. Goldman Sachs says people haven't been this little allocated to stocks since the beginning of the 2000s. So in other words, potentially somewhere up to a 20-year low allocation to stocks. And Goldman Sachs surveys suggesting that 85% of their clients are either bearish on stocks or neutral on stocks. And that's leading them to say, where are the bulls? So on one hand, a lot of this seems like it would be bad news. If we have more inflationary pressures and we have to start undoing the rate cuts we're pricing in, maybe stocks should fall. But then again, if stocks have such little allocation and people are already so bearish on the market, is it possible the market can hold up? Well, if we use Bitcoin maybe as somewhat of a leading indicator, Bitcoin doesn't seem to care that much. Now, what's remarkable here about Bitcoin is it has been sitting at this 28,200 level, which is one of its Fibonacci retracement lines here off of the low of 15.4. This is actually a fantastic sign that maybe the fears of this oil price disaster are a little overblown. Not entirely sure, but it's a good potentially indicator if you believe that Bitcoin pricing is reflective of maybe more of a market pricing. you have an open order book 24/7 rather than sort of more of a market-based timing when you're just in the stock market. Even though we have pre-markets and after-markets, liquidity is so little in the stock market. Sometimes Bitcoin can be a good indicator, and this would not be an indicator of fear. Though Larry Summers says we have a 50% chance of repeating the banking crisis, this could obviously lead to fears that at the same time as a new banking crisis, we could end up having sticky inflation. We could even be in an environment where we're still doing and conducting quantitative tightening while at the same time cutting interest rates, which then you wonder, okay, well, which is going to be worse? And it's possible quantitative tightening could be worse. You could have low rates and a tightening cycle, and it would be somewhat confusing to markets because not even markets understand. And anytime there's, or what would happen with the Fed itself doesn't even know what quantitative tightening will end up doing to the economy. And generally, when there's confusion in the stock market, stocks tend to go down. So that'll be quite interesting. At the same time, you've got the European Central Bank warning, look, now we've got inflationary concerns that could end up being sticky. We've got some financial woes, and on top of that, the real estate fund market in Europe has tripled over the last 10 years. It's a $1.1 trillion market. And if there's any kind of surge in redemption requests, which we've already been seeing in America, then you could end up seeing an increase of housing inventory and commercial real estate inventory, leading to real estate pain, which potentially real estate pain could lead to consumer pain. As Robert Shiller told us, it's not actually stocks going down that affect people's spending. It's actually real estate spending or real estate net worth that affects people's willingness to spend. That's scary because if that's true, then that means the real pain is still ahead. That means the real estate price pain is still ahead. But if that real estate pain comes to fruition, then we actually get the real EPS pain. EPS pain is, of course, what Morgan Stanley's Mike Wilson has been pounding the table about for months, suggesting, hey, we're probably going down because once those earnings prices earnings forecasts for companies actually come in accurately based on the spending we're expecting, and people have run through the amount of excess spending savings they have, then we're going to face real problems. That's sort of been Morgan Stanley's point of view. And it's not only just him, it's also other writers over at Morgan Stanley. Here's another piece from Morgan Stanley just out this morning. And they're talking about, given the events of the past few weeks, we think guidance is looking more and more unrealistic. And equity markets are at a greater risk of pricing in much lower estimates for earnings ahead. This is typically how bear markets end, i.e. PE multiples fall precipitously and unexpectedly, catching many investors off guard. The recent underperformance of small caps and low quality stocks suggests this could be imminent. I mean, now you've got Morgan Stanley basically saying there is an imminent massive stock market crash coming, and the oil price cuts and fears around inflation start that, with the uncertainty of whether or not we're going to get more of a banking crisis. And now you've got too many indicators lining up for Morgan Stanley to be happy over here, suggesting, hey, we're going too fast here. The inverted yield curve has never been wrong before. Why would it be wrong now? And this is actually something that JP Morgan reiterates as well. Let's go back to that JP Morgan piece here. And if we go to their chart of the inverted yield curve, which you're probably already familiar with this, consensus view for a soft landing, but the yield curve thus far has never been wrong. I suppose then the question is, okay, well, who says, a soft landing can't just be a little shallow recession, like a little baby recession? But then the question is, well, is a baby recession actually going to be enough to get inflation down? That's the big question. Because if you can't get rid of inflation, then you end up with higher for way longer. And that's something that nobody's looking forward to. So how do we reconcile all of this? Well, look, I've been of the mindset pretty heavily that the best way to get through this is with pricing power style stocks. And a Goldman Sachs analyst here, I think, made an interesting point. They actually wrote here a bull case for tech. And they talk about basically how if there ends up being growth scarcity, that is, if the market overall ends up having less growth, and that is basically companies that are staples, defensives, defensives, real estate, healthcare, and utilities, if these, and even some discretionaries, if these slow down and we end up having a growth scare, where all of a sudden a lot of the S&P 500 stocks are actually starting to suffer, what could do well in a low growth environment or a slow growth environment? Well, Goldman Sachs goes as far as suggesting it's tech. It's actually tech. Tech is going to potentially be that survivor where when there's a lack of growth everywhere, investors just go, okay, well then let me go back to growth stocks, which is mostly tech right now. Now, I personally refine that further and I suggest you want pricing power style tech. And that's where I like investing in the miners, so to speak, of pricing power artificial intelligence, which to me are high free cash flow companies that are potentially getting those big fat stimmy checks from the government, whether it's energy like an Enphase or autonomy plays or AI plays like NVIDIA. I think these are great opportunities, and I think those are the ones with pricing power. Now, some people say, oh, Kevin, it's Google, but I get really worried about Google, as we talked about in the course member live stream just last week, which remember, you can get lifetime access to those course member live streams linked down below. But the course member live stream just last week, we were looking at Google, and 69% of their revenues come from search. How the hell are you going to tell me that if 69% of Google's revenues vanish, Google's going to do good from AI? Now, yeah, they could grow their AI income, but you're starting at zero, whereas the big bulk of your income is advertising revenue based around search. But if AI replaces 50% of search, now you've just lost like 34-35% of your revenue. If AI replaces the need to ever use a search engine, you just lost 69% of your revenue. Good luck growing from there. Now all of a sudden, you go from looking cheap and like a value play with your multiples to actually being a value trap and people actually paying 5 times the multiple they think they are paying today. Scary. Things to keep in mind. Fundamental analysis is a lot more than just plugging data into an app and then looking at the app outcome and going, oh, the PE ratio looks good. Oh, yes, I will buy this stock because the ratios look good. Like the story also has to make sense around it. And it doesn't make sense for Google right now. It's not to say that Google can't float up with the rest of the equity market, but all in all, yeah, I mean, these are things that create nervousness. I personally think most of the inflationary concerns will be that we require more patience, but that we continue a downtrend. And these fluctuations in oil prices, I think, will be offset by the fact that oil prices and oil demand, rather, and natural gas demand has been declining since 2019. We peaked out in oil demand in 2019, and we're obviously trying to manufacture more or produce more. We can't produce as much as OPEC plus can, so we can't fully offset it. So we're going to have some price increases. But then the question is, how much of that is just pure speculation? Because if we do end up trending towards even a shallow recession, oil prices will probably have a lot more to fall. One of the reasons, by the way, you are seeing oil not do so well at the beginning of this year, and one of the reasons it had its worst quarter since April of 2020, which I realize that's a month compared to this first quarter, that was a magnitude drop, which was insane in April of 2020. The point is to compare this first quarter, and say, it's been bad. Okay, it hasn't been this bad in a while for oil. One of the reasons is because the speculation that China's reopening was going to lead oil prices to surge and commodity prices to surge. I remember pounding the table in December going, that's bullcrap. It's not going to happen. Sure enough, it didn't happen. Now you have speculation, okay, well now OPEC's cutting. Whatever. Eventually, OPEC will be irrelevant. Yes, in the near term, they're still very relevant. So yes, there is some headline inflationary impetus to this, and a lot of it, I think, is based off oil speculation. So it is a downside risk. However, and hopefully, it's transitory. Now, I don't like using that word, but it is entirely possible that the speculation of oil's going to 100, oil's going to 100 leads to short-term rally in oil, and then people start taking their tendies, just like they should have done in January when oil kind of capped out before this quarter began. We'll see. All I know is this is a perfect opportunity to remind you to get life insurance in as little as 5 minutes by going to metkevin.com/life. You get lifetime access to those programs on building your wealth, linked down below, metkevin.com/join, or just go to meetkevin.com. You can see everything I got there, affiliates, the ETF I manage, the courses on real estate or stocks and psych. And really, I'm sticking strong to my strategy. I put my money where my mouth is. I put my money all in my PP, pricing power stocks, and I think we're gonna keep doing well. So we'll see. I'm optimistic. Hope you are too, and I hope we're right.